A simple valuation ratio is the topic of today's presentation. We're going to explain how we've developed a valuation ratio that differs from the price to earnings ratio, and we're going to explain how each of these ratios work. So, intro to price multiples. This is another way they refer to ratios. At the top there, price to earnings ratio. Not important in this presentation to talk about what that is, but you've heard of it, of course, because it's the most referenced price multiple out there. Then there's price to book ratio. That's not something that I personally have ever used or find useful. And there's price to sales ratio. That's most relevant to what we're going to talk about today. Stock price per share divided by sales. We'll talk about that. That sounds a bit confusing, and it's actually quite simple. Price to cash flow ratio. This looks at operating cash flow per share. We recently did a presentation that looked at, I'll put a link to it in the description of this video, that looks at the difference between operating cash flows and free cash flows. It's quite interesting. Now, the problem we're trying to solve for is this. Most disruptive tech companies aren't profitable. So price to earnings ratio, that goes out the window. You can't use it. It won't work. Same with price to cash flow. Though some disruptive tech companies do have positive cash flows, and that's when the rule of 40 comes into play for SaaS firms. We covered that in a recent presentation. Now, revenues are important for disruptive growth companies because they're a proxy for market share being captured. So when we wanted to develop a valuation ratio, we knew it had to take into account revenues. Everything we do here at Annualized is based on the KISS principle, which some of you will know as keep it simple, stupid. So market cap, that's the market cap of the company. You can go to Yahoo Finance and easily look that up. Divided by annualized revenues. Simply take their last quarter and multiply it by 4. Very simple. Let's do an example here, Snowflake. Market cap, $48.5 billion. Last quarter revenue, $2.7 billion. So you take 48.5, divide that by 4 times 2.7, and it's 18. That's your simple valuation ratio. So some people will say, isn't that the same as price to sales ratio? That's a very good question. So our previous definition of price to sales ratio said stock price per share divided by sales per share. Forget about the per share. That's a useless extra step that makes it very complex. Price to sales ratio is simply market cap divided by revenues, all right? Similar to ours. What's the difference? Well, it's about time frames. So what you could do is you could say it's based on last year. Well, that doesn't make any sense because of that whole fiscal mess. So you're trying to compare companies that may have different fiscal years. A good option is to use trailing 12 months, and that's frequently how price to sales ratios are calculated. But we find it a little less easy to use than last quarter. And also, when we use last quarter, we find that to be very responsive to a company's revenue growth. And Snowflake would be a good example of that. Thus, we coined the term the simple valuation ratio. We also refer to this as SVR. So it's simple, right? We understand it's intuitive, market cap divided by revenues. So it's an indicator of how much you're paying for revenue growth and of course that differs by theme of how much you should be paying and the size of the opportunity, but it's easy to use, it's responsive, and there is an exception to this, and that's seasonality. So take a look at this example. This is a firm called Olink, and our very intelligent paying subscribers were quick to point out that the simple valuation ratio and the way that we calculated it didn't work well for Olink because there's seasonality. And here you can see that. Look, in the fourth quarter, you see how revenues jump. They almost double. So here we would want to use trailing 12 months, and that will actually drop that simple valuation ratio from 22 to 16.5. So that means it actually falls below our cutoff of 20. We have a rule here at Annualized that says we don't invest in stocks where the simple valuation ratio is greater than 20. And we're going to talk a little bit about how we're going to make that rule more objective. Now, some important things to note here. Other rules we have. Investing pre-revenues. We don't ever do that. We don't recommend anybody should do that. A company needs to have more than $10 million per year, what we refer to as meaningful revenues. Then, if we only invest in a simple valuation ratio of less than 20, we can imply some things from that. So we can imply that a company must have $12.5 million in quarterly revenues before we'd invest. That would be $1 billion company. So that's our size rule that says we don't invest in a company unless it has a market cap greater than $1 billion. And it has to be doing $50 million a year annualized based on that rule, right? So our simple valuation ratio then keeps us from investing in companies that haven't proven their traction or have developed some momentum in whatever space they're operating in. So our simple valuation ratio, we can also then take that and calculate it for a handful of stocks in our catalog. More than that, we're doing somewhere around 100 calculations for that. So what we can then do is take that population and average it. And you would have heard us talk about the catalog average 6.5. Well, our new average that we've calculated is 6.9. And if you're not familiar with our tech stock catalog, it's about 464 tech stocks that we've put in an Excel spreadsheet, and it's quite rich. I think there's somewhere around 26 fields in there. It has all the tickers. We have Refinitiv data lookup that automatically pulls in market cap and price. We have a notes field that gives a couple sentences about our opinion. We have love, like, or avoid, our classifications for these, linked to the latest research piece. But we also have this rich data set that you see here, which is fundamental data, and I've highlighted one there. You can probably figure out which company that is. It happens to be the most richly valued company in our tech stock catalog. However, if you look at these, you see these values we're calculating here. We have last quarter revenues and then market cap you see there, so we can use that to calculate to the annualized valuation ratio. Well, for that company, they recently had a blowout quarter, went from $6 billion to, I think, $13 billion. So that valuation ratio fell somewhere around 20. So it no longer is the highest in our catalog. And what we will do is update this data about once every 3 months or so. And that way the valuation ratio here will change to more accurately reflect the company's valuation. But what we did is we went through this. We removed several bankrupt firms. We renamed our delisted tab that we moved firms to removed. We checked outliers on both sides. We want to make sure that that average isn't being skewed by outliers. And some of those bankrupt firms were skewing it a bit, dragging it lower. We then filtered on our SaaS column for some SaaS and pure SaaS, and we added valuation ratio data along with the other data that you see there for these companies. That moved our catalog average from 6.5 to 6.9. So let's call that 7. And here's a new rule that we've been talking about in our Discord server with paying subscribers, and that is we want to always make things objective, and we've decided that our maximum that we'll pay needs to adjust with the overall market's valuation, so we can simply take 3 times our catalog average and say that that would be the maximum we would consider paying. So instead of 20, that would move to 21. So this is the formal announcement that we'll start incorporating that. Catalog average times 3 is the maximum that we would pay. Now, another thing that premium subscribers have raised is how to calculate simple valuation ratio over time. Well, we're going to give you an example of how to do that. So if you we'll use UiPath as an example. You go to Yahoo Finance, look up UiPath, click the statistics tab you see there along the top, and it's going to pull up these values here, market cap over time for each quarter. Then what you can do is you can take these, of course, and very easily pull up the quarterly revenues and then calculate your simple valuation ratio over time. We've done that here. You can see this is the market cap, the quarterly revenue, and the simple valuation ratio, and then you can plot it. It doesn't take very long to do this at all. And here what we can learn is that the simple valuation ratio has declined and stabilized right around our catalog average of 7. Look at the average of all those 4 quarters, 7.7. We'll round that up. That becomes our target. We say we're only going to pay less than 8 for UiPath. And on dips, that happens to work very well. And also a takeaway from that is we believe this is a fairly compelling firm to invest in because in good times and bad, firms want to automate and create efficiencies. That's what UiPath does. So the fact that this is trading around the catalog average, we believe that it should trade above that because it creates efficiency. So we find this to be a compelling stock to own. Here's another example. We've done the same for Snowflake, and look at the trend here. That simple valuation ratio decreasing over time as the share price stays stable and Snowflake consistently grows their revenues, then you would expect SVR to decline over time. We can take the average over the past 4 quarters. That comes to around 21, and that's roughly what our target is for Snow, is to invest at 20 or below. Of course, you can set your own targets, but this is a great objective way to come up with targets using simple valuation ratio. So just to conclude, make sure you have objective rules that keep you from overpaying, whatever those might be. For disruptive tech stocks, we use simple valuation ratio. Now, a new product we've developed, our annualized new money portfolio, has defined SVR targets, and similar to the examples that we've showed you, defined SVR targets for the 10 tech stocks in that portfolio. There's also 10 dividend growth stocks, but for the tech stocks, we've defined targets. Experience, which is really time, will help you gauge good targets. That's why we didn't need to use averages to understand that Snowflake under 20 was where we would want to buy. It doesn't mean Snowflake's not going to go down to 10. It just means that we have that target, we utilize it, and over time, the important thing is that we're not overpaying. Note that low SVRs aren't necessarily good. And when we did this catalog review exercise, we found some of the lowest SVR ratios, we're talking below 1 or around 1, were indoor growing firms. And we recently did a piece on cannabis and indoor growing that showed how the bottom just fell out of that particular theme. So it's quite interesting to see 3 firms trading with very, very low SVRs. That shows the market expectation of future growth is quite low. Now, here at Annualize, we don't run ads, so you can help support our work, please, by liking this video. And I'm going to put up another video here for you to watch. Before you watch that, please click the Annualize logo on the right, subscribe to our channel. Thanks so much for taking the time to watch this today.